Welcome to No Nonsense Nonprofits. Hi, I'm Sandy Ray, founder of Sandra E. Ray, CPA, where we alleviate financial headaches so that you can create a bigger impact. Today, we're talking about common errors in financial statement presentation. Now, the accuracy and the clarity of your financial statements are essential for your internal decision-making and building trust with your donors, grantors, and regulatory bodies. But despite your best intentions, common errors can easily creep in, leading to misunderstandings, compliance issues, or even funding challenges. So today I want to address each part of the financial statement and the most common pitfalls associated with those statements so that you can provide a true and reliable picture of your organization's financial health and fostering greater transparency and accountability. Now, the first financial statement I want to talk about is the statement of financial position. Now, the common errors here have to do with asset classification as operating or non-operating, or their liquidity. As you know, the things that are most liquid are at the top, the things that are less liquid are at the bottom. So we're going to be talking a lot about endowment funds and long-term restrictions. As far as cash and cash equivalents, if you're holding some cash that is for an endowment fund and you're waiting to purchase some long-term investments for that endowment fund, these cash and cash equivalents should not be included in your top line for your cash and cash equivalents. Now, same for cash and contributions receivable by restricted donors to purchase buildings and equipment or to create an endowment fund. These should be separate from cash and contributions that are available for operation. Investments of endowment funds and split interest investments should not be combined with your operating investments. So again, we're talking about these long-term versus short-term with restrictions. And then finally, when our board designates funds for a long-term purpose, these should be displayed on our financial statements as long-term investments and not included with our short-term or available for operations. Now, in our statement of activity, we're looking mainly at revenue classification as restricted or unrestricted. These are where the most common errors are. So when using the terms restricted or unrestricted, when I say restricted, I mean net assets with donor restrictions. And when I say unrestricted, I mean net assets without donor restrictions. And those are the proper terms for the financial statements. Revenue from exchange transactions. So if you have program services or you have memberships, these are exchange transactions, and they should go into the increase of your unrestricted net assets. Contribution revenue from pledges by donors in a future period, those should be classified as temporarily restricted because you've got revenue that you're not going to receive for a future period. When they are received, then that revenue, then that classification can be released. Now, net investment gain and losses, when the underlying gift was restricted, those net investment gain or losses need to be recorded as restricted as well. Check your written agreements. That you may be required to do that or not do that depending upon your written agreement. And then finally, gains and losses from the disposal of fixed assets are classified as operations. Now, moving on to our statement of financial expenses. The common areas here are just missing things or netting things together that shouldn't be netted. The first thing we want to talk about is include in your statement of functional expenses any expenses that got netted to revenue on your statement of activity. For example, bad debt expense. If you netted that against revenue on your statement of activity, this still needs to be shown in a separate line item on your statement of functional expenses. We want to make sure that we're including even our non-operating expenses. So if you have non-operating expenses on your statement of activity, they need to be included in your statement of functional expenses as well. We do not include any losses or equity transactions as expenses in our statement of functional expenses. And then as far as the format of the report, we want to make sure that our natural expense classifications are adequate and proper. We want to look at those groupings of our line items. Do we give enough detail there that gives the financial statement reader sufficient information? And then our columns, we want to make sure that we have enough breakdown there. It's not going to match our statement of activities exactly. We're going to have program, administration, and fundraising, but generally we're going to break down our program section into our major programs. And then we want to make sure we have adequate allocation methods so that the expenses are spread across the programs, administrative and fundraising adequately. So we're giving a clear picture of what our overhead looks like. And then finally, we want to make sure that anything we put on the statement of functional expenses agrees to the other statements and our disclosures in our financial report. And then finally, we're going to talk about the statement of cash flow. Now, common errors here have to do with getting the activity in the correct section, whether that's the adjusting section where we look at the adjustments between accrual and cash basis to get to our cash flow from operations, or whether we're talking about the investing section or the financing section of the report. We want to make sure that our gains and losses on disposition of fixed assets are included in two sections. The proceeds from the sale go in the investing section, but the gain or loss goes in the operating section. The other thing we want to make sure is properly classified is contributions for long-term investment in fixed assets. These get included in the financing section. Now, if we have board designations that we've talked about before, where the board has designated some funds to be for long-term purposes, this is excluded from the statement of cash flows. It's not a change in our cash flow. It's just a change in the way the board wants to reserve those funds for a purpose. And then we want to make sure that there are several classes of areas where things aren't netted together. We want to show the gross, both the out and the in. So if we have purchases of fixed assets, we show those separately from the proceeds from the sale of fixed assets. The same for investments. Any purchases of investments, we're going to show that separately from the sales, the proceeds from the sales and investments. And then finally, if we have proceeds from debt, we're going to show that separately from the cash payments to pay off that debt. So we want to make sure that that netting is not occurring. So we've covered several common areas of potential misstatement. By paying close attention to things like fund classification, asset reporting, and restricted funds, you can ensure that your financial statements are accurate, clear, and compliant. This leads to accurate and timely reports that are transparent, that help you make your internal decisions, but also strengthen your trust with your donors, your board members, your constituents, and the public, and thus making your organization's credibility stellar and giving you the ability to sustain your organization's financial health. I want to thank you for joining me today. I hope this was helpful. If you have any questions on this or other topics, please put that in the comment section below. Of course, we always appreciate your likes. And remember, creating a bigger impact starts with stopping the nonsense. If you're dealing with nonsense in your nonprofit organization, we'd love to help you cut through the noise.